So สวัสดีทุกคนนะครับเราก็ welcome to this the IVL Capital Markets Day 2018. As you can see, our theme for today is on the path to long-term value, and we have executives here to explain every step to you. What will happen, the order of events today is the first person to speak will be Mr. Sanjay Ahuja, the CFO of IVL, and he will summarize the financial results. After him, there will be Mr. D.K. Agarwal, the CEO of the Pet and Feedstock Division, who will review the business side of things. Then I will invite Mr. Uday Gill, the CEO of the Fibers Division, who will discuss how we are creating value with our HVA products. Next, a special guest from Europe, Arnaud Closson, the Managing Director of Glanstoff in Europe, who will discuss our automotive and tire business. And then finally, Mr. Alok Loya will take the stage to discuss the future of the company up until 2021. And we will hold a Q&A after all of the presentations. But if you do have any questions, I would ask you please to write them down if possible, and then we'll save them all for the end, when all the management will come on the stage at the same time to help answer your questions. So there's no need to wait any further. I'd like to invite Mr. Sanjay Ahuja, please, the CFO of IVL, to take the stage and commence his presentation. Thank you, Sanjay.
Thank you. Good afternoon. Richard has been very kind. He has allocated me 3 full slides here. He says that even though 2017 results are very exciting, but they're already 2 days old since the time we reported to you. And more importantly, 2018 and 2019 numbers are going to be more exciting. So he wants me to move on and have the exciting speakers come in. So as you see here, the 2017 financial results, production went up by 4% year on year, and that here is the smallest number you see on the slide. Our capacity utilization was 88%, as against 86% in 2016. We did have some drop in production because of China PET, Indonesia fibers, because of turnaround, as well as some other reasons. Rotterdam plant was down for tying up the expansion capacity. IVOG had a catalyst change in the second half of 2017. We had some lower production in Canada due to turnaround, as well as we lost the production because one of our customers, M&G plant, had a closure. Some of these were made up by Glanstoff as well as Durafiber acquisition. But even with this 4% increase, our core EBITDA went up 30% from $775 million to $1 billion. And core profit went up 68% from $274 million to $459 million. Regionally, North America continues to dominate our EBITDA performance, contributing 44% of our overall EBITDA. But this time there was a switch between Europe and Asia, with Europe contributing 34% and Asia contributing 21% of the EBITDA. Europe is higher because of the contribution we got from our IPA business in Spain. Asia is lower because, as I said, China and Indonesia had some turnarounds. India, Micropet also got deconsolidated into a JV, so we lost whatever production we had in 2016 was not there in 2017. There is a production, but because of JV equity income, the equity accounting, the production is not clocked. Also, PTA margin improvement, which will come later in the presentation, will only show up in 2018 as PTA volumes were already contracted for 2017. HVA gave us 53% of our EBITDA, and in the coming years, this percentage is going to tilt towards necessities as cracker volume, Rotterdam volume, and other necessity volume grow. But the 45-50% of HVA in the coming years would be of a significant higher EBITDA, higher pie, bigger pie, I would say, therefore a corresponding higher value for HVA. Core EPS is 2.91, which is 63% increase over the 1.78 in 2016, and that too with the diluted shareholding because of the warrant 1, which was exercised. Operating cash flow was $918 million, which was a 24% increase over last year, number of $743 million. Dividend payout is proposed to be Bhat 1, which is 50% higher than what we delivered in 2016. In terms of core EBITDA per ton, as you can see, it has been stable over a few years, but in 2017, this was $110 per ton, and we recorded this 3-digit number over the 4 consecutive quarters of 2017. The EBITDA per ton has been more pronounced, increase has been more pronounced in second half of 2017 as compared to first half of 2017 and also 2016 because of the changed market conditions. Overall, IVL the second half EBITDA per ton was $117 per ton as compared to $104 per ton in the first half of 2017. And the corresponding number in 2016 was $91 per ton. So year on year, we clocked 28% higher in the second half. On the EBITDA margin percentage, despite the higher oil prices we saw in 2017, EBITDA is 11.9% of the revenues, which reflects the higher quality of earnings, and this compares to 10.7% in 2016. ROCE in 2017 was 11.8% as compared to 10.5% in 2016. In fact, it touched about 15% in Q3, but was lower in Q4 due to the lower production we had in China and Indonesia, as well as Canada. But with the warrant money coming in, we used it temporarily for making the supplier payments, which means the capital employed goes up and you record a lower ROCE. Return on equity was significantly higher in 2017, coming out 16.5% as compared to 12.5% in 2016. In terms of our cash flows, you can see how our net debt is at the end of 2017. The strong earnings and the operating cash flow, coupled with warrants, one exercise made our net debt to equity at 0.75. The net operating debt, which carves out the debt for the assets not yet operating, and specifically the cracker in this year, was at 0.54. It was $1.95 billion in value, which is $300 million lower than what we had in 2016. The ratio, in fact, sits at now at 0.45 with the additional $220 million we got from warrant 2 exercise in January, which was partial money, partial exercise of the warrant 2. So coming to 0.54, and then with our business plan, estimated earnings for 2018 and 19, and with the warrant 2 exercise for the balance 200 million warrants which remain, we expect this net debt to equity to be approximately 0.2 at the end of 2019. And as most of you have seen, we have always maintained a very high financial prudence. And accordingly, if we were to just take 1:1 ratio, which is our longer term cycle stated ratio, we would have 7 billion war chest for investment, and which is over and above the committed $1.8 billion, which is already there built into this in this business plan. Lastly, I think with these ratios, we have been able to move. As you know, we are TRIS rated domestically. We are A+ stable for the last few years. We got A+ positive outlook. We expect, of course, this to go up, and in fact, we would be pursuing TRIS to take this higher in the coming year. Thank you. That's my presentation.
So thank you, Sanjay. Mr. D.K. Agarwal now for business.
Very good afternoon. As Sanjay mentioned, we are very delighted to report the results of 2017, we achieved a highest ever core EBITDA of $1 billion, a growth of 30% year on year, and we enhanced our EBITDA per ton to $110, as you saw, an increase of 24% year on year. This demonstrates a sizable improvement in the quality of our portfolio and earning. We delivered strong earning in feedstock and PET segment by ongoing strategic acquisitions and improving margins. Our HVA strategy continues to deliver enhancement to our earnings in every segment. And importantly, we improved our return to the shareholder, as you saw the earning per share. Our strategy of integration, geographical diversification is working and is translating into the results. Our aim is to ensure IVL continues to win in the marketplace and delivers a superior returns over the short, medium, and long term. Let us now look at the business highlights. We are in a very unique position. Today, the world macroeconomic factors, if you see, the world is expected to grow at 3.7%. China is growing, India is growing. So global polyester consumption growth continues 1.5 or 2 times the GDP growth rate. PET has retained its position as the world's preferred packaging solution. Polyester fibers are also proving to be the product of choice in industries that are benefiting from macro trends, such as personal hygiene and personal safety. Demand for HVA fibers is expected to continue to grow at a strong 6 to 8% annually. Actually, China recorded a 12% polyester demand growth in 2017, and very strong growth is expected going forward. China's supply-side reforms and decisive move to protect the environment is resulting in closing of polluting facilities across the value chain. China's recent ban on imported waste PET, that's about 2.5 million tons, will create new demand of virgin PTA and MEG in the Chinese market. This means there will be more stronger demand, and it also helps our recycling business because the bale prices will come down as we have recycling facilities outside China. Lower inventory levels of PTA, higher demand growth, and capacity balancing creates a positive outlook for the Asian PTA, which has started recovering strongly. Today, the margins are about $130 per ton. Expected improvement, as you see in Asian PTA, should have a strong positive impact on the global PTA and PET capacities in the spreads. So let me explain. When the PTA margins in Asia goes up, basically the raw material cost goes up in Asia. This means the import parity in Europe and America goes up, and we have substantial business there. So it has a pull impact on the spreads everywhere. Expected rising freight rates and duties across the world are further increasing the import parity prices, basically, which improves the spread. The ongoing restructuring, which is a very important event which has happened in second half of 2017, of the two of the leading PET producers in key markets of America and Europe in the second half of 2017 has resulted in a structural change in the business outlook of PET, as demonstrated in the second half earning of PET, particularly in the Europe and America. To sum up, we expect a strong operating environment driven by steady demand growth, capacity balancing, and industry reorganization. So I think IVL is in a unique position with a strong volumes available. Now let's go to the different business segments. Asia, the chart on the left shows IVL and industry spread for Asia PET for the last 4 years and outlook for 2018 and 19. We are using the same concept for other IVL necessity businesses to show where we are in the cycle and how IVL spreads compare to the industry. IVL spreads are always better because we sell domestically, we get better discounts, we have unique positions in the different markets. As you can see, the industry spreads bottomed out in 2016 and are on a recovery path. IVL spread follows the historical industry trend. IVL commands a premium over the industry spread due to our mix, integration, and other factors. What are the key drivers for margin recovery in Asia? Continued strong demand, and the lightweighting has finished in the key markets such as Indonesia, India, and China, which are expected to grow rapidly 11%, 12%, and 7% during next 5 years. So the developing world is continuously growing. Limited new PET capacity additions outside of China. So you can see that graph shows that there is a limited capacity addition outside China. Actually, we acquired many of them like Polyplex, Dhansri's, Micropet, and also we are looking at some other assets. With Japan introducing anti-dumping duties on China. Now this is a new development, as you might have seen that Japan has levied anti-dumping duty on China, which has resulted into the export of nearly 300 KT was going from China to Japan. Now that is being served from our Indonesian and Thai location, and we actually command premium because China was having zero duty, Thailand has zero duty, but Taiwan has 6.5% duty. So that gets reflected in our premium over the industry. So Asia is in a unique position. Our spreads are pretty strong and continue to remain strong. We are going to debottleneck GIVL, as Sanjay mentioned, in the fourth quarter we debottleneck. Rayong we are debottlenecking, so there will be further addition of the capacity. And we will be consolidating the Indian operations going forward. Turning to Asia PTA. Asia PTA margins, as you can see, recovered steadily as our capacity reduces and demand boost from replacement of recycled PET adds to the strong polyester growth. As you can see, the Chinese inventory and 2017 was at its lowest level in many years. Inventory levels of PET in China have reduced from earlier 25 to 30 days to less than 10 days. So it has actually, as I was telling you, the margins has gone up to $130. IVL has seen the improvements in the PTA margin in Asia in line with the margins growth in China, although it is not visible in our performance because we locked in the contracts based on PX. So the new results will come in 2018 when you will have the improved margins coming up. Higher coal prices have also impacted the cost and resulted in lower EBITDA. Our pricing has been reset for 2018 onwards, and we expect to recover EBITDA proportionately. So you will see the results of Asian PTA improvement in 2018 first quarter. Going forward, little new work scale capacity is scheduled before 2021, with incremental growth in supply having to come from restarts of higher cost PTA assets. PTA spreads will continue to improve, as I was just saying that they are on an improving trend. This process has already been underway for the past 12 to 18 months. Expected positive impact on global PTA as well as on global PET since import parity will go up. So Asian PTA improvement actually has impact on the entire world's PET because import parity prices are determined. Let's look at the Asia fiber business. Turning to Asia polyester fiber business, Asia PSF margins have increased in 2017 and expected to continue to remain strong as overcapacity reduces and demand boost from replacement of recycled fiber adds to strong growth. China's supply side move is two-pronged with environmental actions and banking regulation that has led to fast-track rationalization of the overcapacity. The margins have improved across the industry as weak players who are running on day-to-day cash flow and did not have the resources to upgrade the technologies have closed down. So you can see the fiber because virgin fiber is going to replace the recycled fiber which was made from the waste. So there is a improvement in the fiber margins. Reduced cotton supply, which is, polyester substitutes the cotton as the major growth is taken away by polyester. Reduced cotton supply, as you can see in the graph, China to be filled by polyester, cotton remains supply constraint in the long term. Rising recycled feedstock costs due to China import has been pushing virgin PSF margin up. So polyester staple fiber is also on an up track. Now this is the Star West PET business. As you can see how the margins have improved. So 2016 saw the bottom of the cycle for the Western PET business. Since then, margins have improved. As you can see, the graph going up. We did not benefit in 2017 except in second half because there were historical contracts. Now we have done the contracts at new levels in 2018. The ongoing restructuring by two of the leading PET producers in key markets of America and EMEA in the second half of 2017 has resulted in structural change in the business outlook of PET and its opportunity for well-managed and committed PET producer like IVL to align supply reliability to the customers. So customers are looking for reliable suppliers, and as you can see in 17 and how the 18 margins are improving. These are all locked in because all contracts are locked in. We benefited from the instability created by ongoing restructuring as customers look for highly contracted volumes due to the risk. The customers didn't want to take the risk that the restructuring would result in plant capacity not coming online. This is reflective of the improvements seen in the second half performance vis-a-vis what we saw during the first half of 2017. Now, there's another important element which is happening is the anti-dumping action in North America. As you can see that how the import, there is the AD-CAS going where 490,000 tons is, which will get announced by April. Now, this is going to tighten the market further. So the ongoing anti-dumping quantification against the 5 leading PET exporting nations to the US is expected to be announced in the second quarter of this year. Even though the imports into USA will always be competitive, and the prices are determined by the import parity, but overall margins are. So this Western PET business is the star right now with a very strong margin. And as I mentioned, the import parity is increasing because freights have increased, ocean freights, as well as the duties, because of the anti-dumping duties, and the duties are determined on the prices. So this benefits Europe and America both. Let's look at the West PTA business. Now, West PTA business margins are also determined by import parity. Western PTA spreads, as you saw, were bottomed out in 2015, and since then there has been a recovery path. Now, increase in Asia PTA margins, this means import parity increases, will have a positive impact on the EU PTA margins, even in US, because the discounts are determined by the import parity. Now, this is a unique opportunity for us. As you know, we acquired the Heartland facility at a very low cost. We are going to start from 1st July. That will add 700,000 ton capacity. We expanded the Rotterdam to 700,000 tons, which is at present on ramping up. So the 2018 will have full benefit of this increased capacity. So Western PTA margins will be also increasing. MEG, another interesting business which we have. As you know, the MEG is on upcycle. You can see that MEG spreads were bottomed in 2016, and this has been on recovery path. The market fundamentals for 2018 and 19 remains strong. Why? MEG, there is a barrier to entry. You need a cracker. Without a cracker, you can't put MEG plant. Now, the economic size of the cracker has been 1.5 million ton. And when you do downstream, you are talking of an investment of $8 billion. Not many people can invest $8 billion. So MEG has a barrier to entry. MEG demand growth in 2017 has been exceptionally strong, with close to 1.4 million ton demand being added, driven by Chinese growth. As I said, polyester growth is pretty strong. MEG margins going forward will likely maintain current strength over the next couple of years, given the high global demand and utilization rate forecast through 2019. So only new MEG plants are going to come more in 2019 with the crackers. Crackers are getting delayed. So MEG is again, and as you know, we have MEG plant in the US, where the ethylene cost is very low. Today, the ethylene cost in America is only 23 cents, which is $500 per ton, versus Asia, $1,200. So this is a great profitable, and we are in the present MEG prices about $1,020 per ton. We have invested in a brownfield cracker in US Gulf Coast, as you know, one of the most cost-competitive region for ethylene production. The facility will provide IVL with a significant long-term cost advantage across its North American footprint. Ethylene cash cost even at present crude price of $60. So as the crude oil goes up, still that becomes much more competitive and highly profitable. Our investment cost is coming very low at $1,400 per ton versus a new cracker, if you build, will cost you $2,500. So even today the payback is 5 years. And this is a upstream integration where IVL gets integrated from ethane to PET and fiber and paraxylene to fiber. I won't cover paraxylene. Actually, paraxylene margin also very strong. So what does it summarize? IVL necessity business, as you can see the graph here, that how the margins are improving. In 2017, we have 217 versus 194. The industry spreads, we always beat the industry spread because of our unique positions, better discounts, better premiums. So second half of 2017 makes a positive structural shift for the industry and our necessity business. Necessity margins expected to continue to gain momentum in line with the industry outlook, while I will continue to maintain a premium over the industry, leveraging our domestic presence, customer reach, and integration. So, as you know, the commodity cycles are on up, and the necessity business is going very strong. Having said that, IVL has shown the strategy of HVA and necessity. We have a very steady HVA business. You can see the breakup here. It's not only fibers. We have PET. You can see the fibers and especially at the feedstock. The feedstock includes NDC, IPA and purified ethylene oxide, we have 42% market share in North America. So IPA margins have been very strong. And in 2017, we acquired Glanstoff, a premium tire cord producer. We also acquired Durafiber in Mexico and France. These acquisitions propel IVL into a position of strength in RAN. I think this will be covered later on. Our HVA portfolio also benefited from the strength seen in the specialty feedstock. As you can see, the EBITDAs of feedstock, which is namely IPA and NDC. IPA had very strong margins. Actually, we have doubling the capacity of IPA, 50% increase in 2018 and subsequently 2019. And this is driven by the tie-up of the feedstock, which is metaxylene, and which we have tied up. So any drop in the margins of IPA will be recovered by the growth in the production. So we have a very steady HVA business. So what does it combine into Necessity and HVA business? So actually we are in a very sweet spot, I would say. We have good volumes. The industry is looking very positive. The spreads are going up, and we are in a perfect point. So we have delivered a strong set of results in 2017, and we are well positioned for the future. I think first quarter results are going to come in a few months, and you will see those results. So we are very upbeat about the industry. Thank you very much for your time. Thank you.
So next, may I invite Mr. Uday Gill, the CEO of the Fibers Division, to talk about how we create value with these HVA products. Mr. Gill.
Thank you, Richard. In the past two sessions, Sanjay and DK talked about how HVA business underpins IVL performance. I will try to share with you how we create value in the HVA business. And if we really look at our HVA business and have to say one single thing, it's all about customer experience and providing meaningful solutions to our customers. IVL has been following this strategy and the vision of our board of directors to continue to grow our HVA business so that we can protect ourselves through the down cycles. And we have found that HVA is away from the cyclicity and gives us steady state returns. So we identified three major areas of HVA in the fiber space, although Mr. Agarwal mentioned about other HVA pieces in the rest of the IVL. In the fiber space, we attach highest importance to three distinct segments which are value creating. One of them is automotive. I will touch briefly on it, and my colleague Arno, CEO of Glanstoff, will cover automotive in more detail later on. And the second major segment that we follow is hygiene and personal care. And then, of course, there are peripheral products around automotive and hygiene area, which we call them industrial, which also attract a lot of value in our business. And lastly, we believe that sustainability and the new consumer is looking for solutions that are more sustainable. And we continue to provide meaningful solutions to our customers based on recycled products. IVL, no doubt, is the largest polyester producer in the world. We are also the largest recycler in the world. Wellman, one of our companies in Europe, recycles bottles back to fibers, and also the fibers which go into automotive, industrial, and hygiene segments. So in the HVA space, what we do is we integrate the IP around various companies that we acquired in the recent years in the West. And we follow innovation, and our innovation index is that the pipeline of new products that we produce is over 20% in the current year's turnover. So that's how we measure ourselves. And secondly, if I have to share with you one single way how innovation works in our business, is that over 25% of our products are protected by either patents or by our proprietary recipes. And what we do is we have ongoing programs with our customers, collaborative projects, over 100 projects going on currently with our customers in the automotive, hygiene, and industrial space, where we collaboratively innovate and work solutions for the consumers. So we are able to bring knowledge from the front-end consumer back to the intermediate space where we are and offer solutions. So just to list some of the solutions that we have been able to bring about and create value for our customers is composites, very extra light composites for automotive space, where we are replacing carbon fibers, we are replacing steel in the automobiles. That reduces the fuel consumption and makes the automobiles more sustainable. And going forward, we are also been able to provide high performance applications for the tires, wherein we are able to provide the safety while getting the thrill for the driving, excitement of the driving. Similarly, in the hygiene space, we are the largest top sheet manufacturer, fibers for the top sheet manufacturers in the world, and that's where we qualify with our customers as we're able to provide solutions for very soft, cuddly fibers for the babies. And similarly, on the recycled area, our fibers go into hygiene, automotive, acoustic applications, and also in the construction business for insulation and sound barriers. Now, to share with you how important and how potential this HVA business creates for IVL. I'm just taking you into a little bit of history. Without that, I can't justify the potential of HVA. If you see, I'm giving last 4 decades. In the last 4 decades, these bars you see are just the incremental volume of fibers. Only the increment, not the total production. In the 80s decade, 80s, 90s, we had just 10 million tons incremental in 10 years, out of which only 2 million went to HVA. And in the current decade, out of the 32 million tons of fibers, total demand increase, 17 million goes into HVA. So HVA accounts for 50% of the incremental growth of fibers in the world. And we, IVL, we attach highest importance to this subject by following our HVA strategy, following automotive, industrial, hygiene. And of course, within the HVA space, we do not ignore the bread and butter business, which is apparel and home. And that's where we go for more sportswear, activewear, and high fashion products. And it's not only that, our innovation that we have, platforms that we have created, it is helping us to penetrate in the apparel business as well, as we see that the fashion and performance are converging. The customers want performance fabrics, like for the sportswear, more and more fashionable. And similarly, the fashion wants more and more performing products. So it underpins both our businesses. So we believe that we have a huge potential in this business, and I will continue to grow this portfolio going forward. Now, just to share with you that we have been also able to diversify not only in the HVA space between automotive, hygiene, industrial, home, apparel, we have also in a very balanced manner diversified into North America, Europe, and Asia. So on the left-hand side, you see the growth happening in all three regions and the growth happening in all the three important segments. This is really helping us to deleverage the risk of our customers as well as ours. Most of the global brands who deal with us, they want to deal with IVL because of their business continuity. It's not only the full range supplier that we are. It is the business continuity for which they stick tight to us. IVL has 27 sites in fiber where the customers feel comfortable that we can supply them fiber from various locations and in various regions wherever they are. So we follow our customers globally, so we de-risk them from the point of view of the business continuity. This not only applies to the fibers, this also applies to the other businesses of IVL being global. Now, wanted to share with you how do we protect our business? How do we protect our margins? On the left-hand side, these are the revenue streams that IVL has created over the years, backed by our IP. These are airbag yarns for airbag applications. We are second largest in the world for airbags, having 25% market share. Similarly, for hygiene fibers, then flame retardant fibers, acoustic fibers, and wipes and medical applications, and then last but not the least, the tire cord. And the yellow bars are the growth in 2017. What you would like to emphasize here, all these revenue streams have approval cycle of between 2.5 to 3 years. In certain cases in airbags, it takes up to 4 years. So this is a very distinct entry barrier to competition. These are the revenue streams that we have created where it's very difficult to enter for a new entrant. But it becomes very easy to defend for someone who is already there, like IVL. So on the right-hand side, I would like to share with you how HVA business helps even our commodity business. The green space is the published price of 1.4 commodity fiber, and the yellow, dark yellow on it, is the premium that we gain on the commodity fiber against the published prices. That comes because of the IP we have, that becomes of the knowledge we have, that gets because of the business continuity assurance we give to our customers. So how does this look in terms of financials, in terms of our margins? On the left-hand side, you'll see the red line at the lowest end is the commodity 1.4 fiber business. And the green top is the HVA spreads. So what HVA does to our fiber businesses, it continuously lifts and increases the overall weighted average spread for the business. Which was 1x, went to 3x. Now we expect that in the coming years we'll be able to pull the average by 4x from the commodity. Similarly, on the right-hand side, you'll see the HVA volumes that are growing. The green line is the HVA spreads. So we not only increase the HVA spreads through innovation and through our application development and collaborative arrangements with our customers, we parallelly look at our costs. The red line below is our cost innovation. So the product innovation on the top, which drives the margin up, and our cost operational excellence and cost innovation keeps the costs under check. So that's how we've been able to improve from 1x to 2x and to 3x. So we find that HVA business has been very proactively creating steady state returns for IVL, and this helps us to sustain through any cyclical activities going forward. So thank you very much about this. And now Arno Claesson, our CEO Glanstoff, will take you forward through the automotive segment and share with you our presence in the automotive area. Claesson.
Thank you, Mr. Gill. Good afternoon, everybody. As a member of Glanstoff and IVL, I would like to talk about the automotive industry and more specifically about the tire industry. And I hope you will appreciate this industry as well. As Mr. Gill mentioned, 2017 has been a very active year for IVL in the tire field with the addition of Glanstoff, but also Durafiber assets in North America and Europe. And with combining, it's better with the slides, with combining now 3 major players in the industry, Glanstoff, Performance Fibers, PHP, IVL has become a major player in that industry. We also have now the full range of products that are being used in the tires, like the polyester, the polyamide, the rayon, the aramid and hybrid combination of these materials. I have been now with IVL for 8 months that we are in the IVL family, and I can tell you that by visiting the key tire companies, we can clearly see a change into the customer perception. And now they really see us as a strategic and global leader in the industry. And as you can see in the graph on the bottom part, this is reflected in this revenue chart where basically we are expecting to grow that business around $0.9 billion with a 40% growth by 2019. And there might be even more opportunities. The tire industry is growing. If you can see on that chart, the car park, which is basically all the vehicles and cars that are in circulation in the world, this car park is growing from 1.3 to 1.5 billion cars by 2021. This represents an additional 170 million cars in the world. Also, the tire production and sales are increasing, and you can see it on the orange chart on the slides. It is expected to grow from 1.7 billion tires to a little bit more than 1.9 billion tires produced every year in the world by 2021. And this represents a little bit more than 220 million tires. All of that will drive the demand for tire reinforcements to a level of a little bit less of 1 million tons, 930,000 tons globally. And as a reminder, IVL has currently 16% share on that market. All of that obviously is driving by some trends in the industry. The demography, the wealth is helping the middle class spendings. The new car model that are being developed in the world, driving the demand for tires. Increasing regulation also is an important factor in the industry, especially for the environmental impact. And last but not least, the new tire design and tire features are driving the demand for tire reinforcement. And obviously, IVL is well positioned to respond to those trends. We have a global footprint now in all regions, which is enabling us to serve our customers in a quick and flexible manner. We have the full range of products that are used in tires. I mentioned the different fibers, but we can also supply those products in different ways. The more traditional way, which is called fabric, used in the conventional tire manufacturing process, but also a more modern and flexible way, which we call single end coat. And this is used for more flexible and modern tire manufacturing process. IVL products are used in very demanding tires. I could name the racing tires, high performance tires, run flat tires, all those applications requires very specific features of the tire reinforcement, and IVL do have those products, and this is a clear focus for IVL. The good news is that this premium market is growing 4 times faster than the regular conventional tire market. So this is giving good hope for growth for the future. And last but not least, thanks to our quality level, highest quality level, customer reliability, but also various and broad product offering, we became a global market leader. We are number 1 in single and cord globally for tire reinforcement as well as for hybrid reinforcement. We are the second largest player for rayon, which is the primarily material used for the high performance tires. And we are the second largest polyester tire cord fabric player in China. And all of that, obviously, we are serving our global or main customer tire companies globally. I could not talk about tire industry without mentioning innovation, which is an essential part of this market. You can see on the left-hand side, obviously, there are major transformation happening in the automotive industry. Electrification is coming with electrical cars. New batteries giving a better capacity is driving the increasing demand for electrical cars. There is a strong focus on fuel efficiency, which is driving the need for lighter weight materials and stronger materials. Connected vehicles, definitely to improve the driver's experience, is a strong trend. We could also mention the shift in mobility. We call it the Uberization. Today, the people are not willing to own a car, but more, pay for the service of the car. And last but not least, autonomous vehicles are becoming a reality, and I think you can read that in all the reports and news with the new players emerging like Google and Apple coming into that market. So all those transformations will have a significant impact on the tire reinforcement, and this is giving a unique opportunity for IVL to work closely with our customers and develop tailor-made technologies that will respond to those needs. As a leading technology example, I could just show this on the right side, or single and cord products that are used in run-flat tires, those tires that you can run still for 100 kilometers even if they are deflated. I would like to make a closer, maybe a snapshot on the electrical vehicle, and I know everybody is interested about this trend, and mostly about the impact of these electrical vehicles on the tires. And those impacts are basically that the tire will have to have a lower, what we call rolling resistance, and this is to increase the driving distance that you can do with an electrical vehicle. Noise control is a definite impact on the electrical vehicle. Once you remove the gas engine, regular gas engine, the major source of noise will come from the tire. So this is a strong focus for the tire industry at the moment. And I could also mention high performance. Often the people believe that electrical vehicles will drive the performance or the requirements for performance down. This is not true. With the high torque of the electrical engines, you actually need higher performance tires to cope with this increased torque. And at the end, this is driving the industry to develop new tires that are looking a little bit different. We call it tall and narrow. This is to reduce the rolling resistance. And also to use lighter weight materials into the tire to reduce the overall weight of the tire, but also of the car. And obviously, thanks to the expertise we have in different materials, IVL is in the forefront development of such trend in the market to develop those tires. And by the way, this is not only true for the tires, but also for all the fibers and textiles that are used in a car. As a conclusion, I would highlight that the combination of the major player in the industry has created a unique positioning for IVL. Our focus on innovation and premium segment is offering high growth potential for the future. We have become a global market leader and well recognized in the industry. And definitely we are working very closely with our customers globally to establish strong and long-term partnership. Thank you.
And finally, I'd like to invite Mr. Alok Loya, the Vice Chairman and Group CEO, to take the stage to talk about our direction towards the year 2021. Thank you.
Good afternoon. Thank you for joining us today. Like my colleagues, the previous speakers, I too am very excited to present here again. And I'm delighted that my colleagues have very clearly explained our results for 2017 and what is in store for us in the coming years. I believe they have shared their very valuable insights on the volumes and margins environment, which is seen as positive after many years of imbalance. Welcome to our new colleague, Arnaud, who you just heard, and is representing the tire cord sector in IVL. This sector truly is a growth sector for IVL and well on its way to become $1 billion business for IVL, I think within the next 2 years. Divisions like tire cord are our hidden gems, and we make an effort every capital market annual day where we try to bring to you one unique business to share that business with you. So this time on the tire cord business, I actually am also very happy to see those slides and understand that business better. So you are not alone if you don't understand our HVA business. Let's start this last few slides on our journey on sustainability. Our debut on the DJSI is gratifying, and especially so because this one metric encompasses so many of our values, all of which are extremely important for the sustainability. We have always had bold ambitions, and for some years have been working towards becoming a world-class chemical company. Enrollments and recognitions from world-class organizations and initiatives help us progress with full commitment towards our goals. A snapshot of our earnings, a very rewarding performance delivered by managements and talented teams across the world, is in itself a unique competence. Our internal processes for budgeting has also been rewarding, as demonstrated in our success in forecasting trends and earnings at each of the diversified levels to deliver industry-leading returns. The senior-most management of IVL, some of us being present here, are delighted by the returns that our strategies have delivered. EPS growth at 70% CAGR is heartening to deliver and a testament to our internal processes, and had been forecasted such growth 4 years ago and had therefore set our W1 and W2 warrants pricing at rewarding levels. This has benefited the investors and also the company, which now has a stronger balance sheet, and therefore we are ready to embark on appropriate accretive growth plans, both big and small, be it organic or strategic. In the last 7 years, our total talent has grown from 6,000 to 15,000 plus people across geographies and cultures. And we have about 22 revenues and let's say diverse, differentiated businesses, which has all grown over the last 7 years from less than 10 earlier. This group of talent has grown our capacity in an accretive manner by 8 million tons. 8 million tons is the size of some of the largest polyester companies in the world. And we have been able to do that in the last 7 years, just grown our capacity to 11 million tons today. We believe our volumes will further grow by 25% in 2018 and 19, alongside improvements in the quality of our earnings. This is achieved by our ongoing CapEx plans and some actions that got completed in end 2017. We are usually considered to be a firm that drives its success from global M&A. And while that is also true, but what may be underestimated is the continuous smart delivery of improving costs and productivity by our talent. Together with incremental investments in hidden factories, our returns and yields show significant earnings improvement historically and going forward. In the last 2 years, we have appropriately invested in our feedstock portfolio, which has supported our earnings growth by 55% to become our largest contributing segment. Actions and investments that are currently underway allows us to guide that we believe our 2019 numbers will be 45% improved over 2017, as well as strengthen our ratios. We believe our strong talent and financials could support new opportunities, provided we believe in the strategic rationale to invest in such opportunities. This particular slide is a brand new slide and a much more granular slide on where we see ourselves in the next 2 years, in 2018 and 19. We took 2019 as a cutoff of our 4-year plan, which is ending in 2021, because of visibility for the next 2 years, 18 and 19, without factoring in any new growth project, which has historically been the case for IVL. We have always had some opportunities for M&A, but without considering any M&A, just based on all the CapExes that are in the pipeline, which are ongoing for us, which is approximately $1.8 billion US, we feel it is appropriate to share with our stakeholders our views emerging from the budgeting and strategy sessions, which we annually do to cast our 4-year plans. Since we have a clear view on where we see IVL over 2018 and 19, we see stronger improvements in quality of earnings in each of our segments and in 2 out of 3 geographies. These you can read in the rows where EBITDA growth is higher than volume growth. The exception being EMEA, since we have budgeted lower IPA margins, although the absolute impact of the earnings will be offset due to volume growth in the IPA business. We see Asia turning the corner, as discussed by the previous speakers, and North America being favorably impacted from the cracker startup soon. Going on to my last slide, this is a little bit philosophical. Opportunities don't come, you create them. World-class companies, similarly, don't just happen, you create them. Indorama Ventures is on a journey, one in which you are not afraid to give up the good in our quest for the great. Our vision is of that journey. The road to success and the road to failure are almost exactly the same. We know how difficult these last few years have been. We know how many of our fellow travelers in this business have stumbled. We have not settled for the ordinary, and we have therefore delivered extraordinary results. 70% annual EPS growth in tough markets. And the key to all of this is our 15,000 people globally. Tomorrow belongs to those who prepare for it today. IVL is well prepared. Our global leadership in PET is well positioned to benefit from the positive structural change that has been in the making these past 6 to 8 months. Our businesses and ongoing projects are fully resourced and funded to help us grow EBITDA by a further 45% by 2019. And in addition, we have a war chest to invest a further $7 billion by the turn of this decade. So, as I know, even by 2021, we will have just begun our journey of becoming a world-class company. Thank you.
Thank you, Mr. Loy. Now, we'll put the seats up on the stage for the Q&A. And what I would like everyone to do is, if you've got questions, prepare them. All the management will be on the stage. Yeah. So we'll move that podium off, get the chairs up there, and we've got microphones for everyone. So just give us 2 minutes to move things around a little bit. If somebody does have a question, these microphones are all live, so please do ask using the microphone so our friends online can also hear the questions before they hear the answer. Please don't forget to switch off the microphone once you've asked the question so that we don't hear you breathing heavily after that. So, we're ready to start. If anyone has a question, you may quickly pop up your hand and ask into the microphone so that we can look at where you are. The management will decide themselves who will answer the question. Who's going to start? Come on. Yeah, over there. Please, go ahead.
Thank you for the presentation. This is Pawaramon from Credit Suisse. Just want to ask you to perhaps give us some updates on potential M&A that, as much as you can talk about, I mean, you know, maybe just a timeline that what we should expect and all that. Yeah, whatever you can tell us. Yeah.
Thank you. You know, there is little that we can speak about the M&A opportunities, especially in North America. But what I can comment is that in each of our segments, that means feedstock, PET, and fibers, there are opportunities. And as we said in our prepared statements, we would be very selective. We would look at companies that have a very good strategic fit to us and which help us to better embrace our customers in the sense that if we think that we can become a more reliable, more added value supplier to our customers, then we would look at those opportunities and value those opportunities accordingly. So the value that we would ascribe to some of these opportunities will be dependent on how strategic and how good fitment they have to our business. There was recently one of the big processes that is going on in North America, one of the plants which was called Apple Grove, previously owned by M&G, has been sold to a new company, and which is actually a very good news for us because as an industry, it helps improve the supplies to the customers. And on a selfish side, that particular site was fed by PTA from our Canadian plant. And this hopefully will allow us to again re-engage with that plant and continue with our supplies of PTA going forward. So at the moment, we can only comment that we have the resources, we have the talent, we probably have knowledge about the markets, and there are a lot of opportunities. So we are in a good position to be selective. Just to reaffirm again, all our numbers that were presented for 2019 or even 2021, all these numbers are without any M&A in them. And therefore, you see our net debt equity come practically to nil. And we have sufficient cash to fund these opportunities.
One over there, Komsan.
Thank you for a very, very informative presentation. I have a few questions. Number one is, what will you do with the 7 billion capex? Because it's quite a big number. Can you add some color as to initially you invest in necessity and then move towards the HVA? And the second question is on page 35. You expect EBITDA to grow 45%, and it seems that that is roughly $450 million, which is mainly coming from the feedstock. Is it fair to say that within that jump is 1/3 coming from cracker, 1/3 coming from PTA, and 1/3 coming from MEG? And the last one is on page 14. You have always been saying the key driver going forward will be volume, but this time around the change is the EBITDA growing from whatever you were saying. Can you add some color, particularly on the EBITDA growth? Again, it seems to be coming from US MEG. Is that because of the cracker that coming up, or something else? And how is that margin sensitive to ethane cost in the US? Thank you.
Thank you. So, not in any particular order, but let me take that last question first. There are also slides 14 to 16, if I remember, which shows you industry spreads versus IVL spreads. And before that, we have shown you each component of IVL, step by step. Can you go to full page? Full screen. Okay. Vikas, you want to handle it? So if you go to the previous slides from there, we have given component by component what the industry spreads have been and are guided versus what our budgets are. So first thing I would like to share is that we have not been aggressive in our budgeting. I'm always trying to make Mr. Agarwal and Mr. Gill be more aggressive in the budgeting. But nevertheless, you can see that in the previous years, we used to have higher premiums to the industry than what is budgeted now for the next 2 years. So that for me is a sort of assurance that what we have budgeted for 18 and 19 and beyond are achievable. I also mentioned in my prepared statements that that is one of the strengths of IVL, our processes and our budgeting sessions and our strategy sessions. And 4 years ago, we did price our warrants at 36 and 43. And we have seen when the share price was only 20 odd baht. So we have a confidence in our processes where we can estimate where we are going, and not only estimate on a aggressive manner, but more in a prudent manner, in order to beat expectations or beat results, beat budgets. So that's one. if you go to the slide, Kun Komsun mentioned 35, and the one next, which shows a 2019 plan. Yeah, this one. This one is quite granular. It tells you by segment where the volume growth is happening and what the EBITDA growth is coming in that segment. So as I mentioned, except EMEA, where the volume growth is higher than the EBITDA growth, which is impacted because of the IPA. IPA enjoyed the best record margins in 2017. And we are anticipating them to come to a more normalized level in 18 and 19. But on an absolute basis, the IPA EBITDA would be higher than 17 because of the volume growth. So the quality of earnings, whether it is in the regions or in the segments, are improving. Yes, in the feedstock, it's the cracker which starts up, which is under commissioning now. And before you ask that question about the cracker, let me tell you about the cracker. The cracker is under commissioning, mechanically complete. It is going through final checks, final environmental permits, and internal target date is to have it in production by end of March. But we have taken in our budgets the production only from May 2018. So that gives you a guidance on where our budgets are set for 18 and 19. Since it's mostly captive consumption, we don't have any pressure on the marketing side of that. As far as the economics of the cracker is concerned, it is over budget, but still, as Mr. DK mentioned, it's at $1,400 a metric ton, which is still very competitive to new greenfield crackers. So, and the returns are in like 5 years, so which is still very attractive. But apart from the cracker and the feedstocks, we have the Rotterdam PTA, we have the Portugal PTA. Those two big plants or those two big businesses will get included. But the biggest recovery is, or biggest enhancement of earnings, quality of earnings is in fibers actually. And that you saw Mr. Gill's presentation. If you go to the premium slide of Mr. Gill, how that 1x, 2x, 3x, 4x. So that 4x is what is going to create the quality of earnings going in 18 and 19. And we are on that journey already. So it is something that is already on its way. And people like Arno and Glanstoff and this whole, let's say, consolidation of industry is helping us to become a sort of a preferred supplier to our customers. And we learn from each other. That has always been the strength of Indorama. Whether it's the fiber sites or the PET sites or the feedstock sites, they all talk to each other. They all do benchmarking with each other. And therefore, they learn from each other. That has really been very useful for us. So on the quality of earnings, we see improved quality of earnings at each of our segments. In PET, that particular slide showed 35% growth of earnings, not 45, because 35% over second half 2017. 45% growth of earnings by 19 is over full year 2017. The reason we selected that particular slide or that particular way to show you the information is that what we have achieved in the second half of 2017 is in the pocket already. By continuing with the same assumptions and just adding on to it all our operational excellence projects, our debottleneck projects, our volumes, we know where we are heading in terms of total EBITDA in 2018 and 19. You know, it's always been a worry by the board of directors on guidance. How do you guide and how do you so what I can assure you is that this guidance is based on numbers without too much of extra meat in it. The only meat that we have built into the guidance is PTA Asia margins. PTA Asia margins have been on an average $110 in 2017. We believe they are on the uptrend, and therefore we have also gradually improved those margins from 110 to 20, 30, and 140 finally. Then we stick to 140. So that is the only one particular segment, Asia PTA, where the margins are not where we have projected for 19, but hopefully they will be there. On the utilization of the $7 billion US dollars, I think it's a good problem to have. So I'm not really worried. I'm not really paying too much attention to that $7 billion. What I know is that Tris would be very happy if I did nothing with that $7 billion and just reduce the debt. But we have to balance that. So we have to balance between what's a prudent level of debt versus maintaining our growth. We have always had this philosophy that change is a constant, and therefore, in our language, change is equal to growth. And we have been successfully following that principle. And as long as there are opportunities out there where we have the competence to acquire those facilities and in a balanced manner serve the customer, then we'll use our balance sheet to do so. So there are opportunities. It's very difficult for us to name which opportunity would happen when, but we are confident that we should be able to, over the next 4 years, use that money wisely and for the betterment of the stakeholders and as a reward to the shareholders. On this note, let me just add over here something which is not public, but since in the 2017 we got this benefit from the tax write-back, deferred tax write-back in the US. So we are going to give an extra bonus to our US employees, and there is a certain formula that is being calculated to reward back to the employees in the US for that extra profit that we have achieved. I hope, Kun Komsun, I covered most of your questions.
Thank you.
But if not, please remind me.
Okay, any other questions, please? There are several areas. Please go ahead, Kun Suwat.
Okay, thank you. The first one, I would like to ask you about the strategic move that you think that you could leverage on the U.S. market change, because in terms of the industry itself, it changed, as well as the country itself. I think the energy also changed, the economy also changed. How you take your view in terms of the 3 to 5 years from today to leverage on that change? Okay. The second question I like to ask about the HVA in specific. Given that today the EV car have been coming, you already mentioned, I think Mr. An already mentioned something about the EV car and the Thai market, but could you expand a bit further on the slide number 15, maybe, that how much portion of your EBITDA that you generate from the auto today, and how you see the auto industry earning that you can generate going forward into your target? That would be my second question. And the third one, specifically back to the slide that we're talking, that 35. I just want to ask that you said that, Mr. Alok, you said that by the next 2 years, you expect 45% growth in EBITDA, but you still have a target to double the EBITDA over the next 5 years. Okay, beyond the 2019, that you already expect 45% growth. And if so, how you achieve that with the organic growth more, or you do more in the inorganic way? Thank you.
So I'll ask DK to talk about North America market to you, and Mr. Gill and Arno, they can talk about the tire business. We generally don't give specifics on EBITDA for a product, but I did mention that our automotive tire business would generate a revenue of $1 billion, and I think it won't be inappropriate to think that we should get to a 15% EBITDA margin in a HVA business. So I'm just giving you off the top of my head. These are not scientific numbers, but as a IVL, we are doing like, let's say 12% EBITDA margin. The commodity would be lower and the HVA would be higher. So I'm probably also putting the pressure on Mr. Gill and Clauson that we need 15% EBITDA margin from that business. So let Mr. Agarwal talk about North America first, and then I capture your other point.
So North America, as you saw the slide, the PET margins went down last few years because of irrational behavior of some producers and dumping. How the anti-dumping works, because when you dump the product at much below prices. So what happened in 2017 second half, that one of the major producers went down and the margins were lower. They were below even the import parity from some of the markets. Now those new levels have been established. So you saw in the second half, but 17 did not get the benefit of contracts because we already had the contracts in place. In 2018, customers got worried how the supply will be made. So we locked in the contracts at much higher prices. Now, industry, still as Mr. Lohia mentioned, there is a bankruptcy process going on of M&G, and those assets are in the Chapter 11. There will be some restructuring as Far Eastern has come as one player. There are opportunities in those markets. North America growth rate is pretty strong. As I said, GDP growth is about 2.8%, as you must have observed. The PET is rapidly growing. We see that this market will remain strong. With our cracker, our integration level increases. I think Komsan asked about ethane price and the cracker, right? Ethane prices are still low as the gas is $2.58 a million BTU. The frac spread is only $1 in spite of Exxon starting up the cracker. So our EBITDA target still remains 130. But MEG integrated margins have increased quite a bit because the MEG price has become 1,020. So MEG to ethane is a substantial increase. So I think the North America remains a very, very strong. The PTA pricing, as you know, is linked with paraxylene formula. And that is also when the crude oil price goes up, this margins goes up. So we are pretty positive about North America. Did I answer your question? Because I wasn't very... Anything else you want to ask about North America?
So we'll come back to that.
Okay.
But Kudsuat, our growth is going to be both organic and inorganic. When we were a smaller company, we grew inorganically because we didn't have the scale. Now that we have 1 million tons already at IVL, there are going to be opportunities how we can tinker with that 11 million tons and make it 12 or 12 and a half or 13. So there would be opportunities to do brownfield expansions, hidden factories, and grow the business organically through operational excellence, which is part of our DNA. But we will continue with the inorganic growth, particularly, as I mentioned earlier, for businesses that are very strategic and which IVL needs to fill certain gaps that we still think we have in our portfolio. One example for that is Latin America. We have business in North America. We have in Mexico, which is part of North America, but we have nothing in Latin America. So there will be opportunities in Latin America for IVL to go into. Similarly, there are other markets where we are not yet present. Africa is still a big void. We have some business in Nigeria, but but there is room to grow our businesses in those markets. So, and more importantly, we have the resources, we have the talent, and we have the balance sheet to do the right things, which creates accretive returns for our shareholder. And when we think of doubling our EBITDA every 5 years, I think if we hit 1.5 billion roughly in 2019, 5 years ago was how much? From 19, that means 13, 14. So even if we take 14, which was at 568, is it? So we would be more than doubling our EBITDA every 5 years. So I think we are on track to continue to double our EBITDA every 5 years. We are, that's not the concern. Where we are in the industry cycle at the moment, I would think is that we are now arriving at the mid cycles. We were in the low cycle till end 16, beginning 17. We have now started going on to the mid cycle. We should be in the mid cycle for the next year or so, and then hopefully we see an up cycle for another year or so before we start trending downwards. So by the end of this 4-year plan in 21, maybe we would start seeing pressure because of new capacity build-ups. But for the next 4 years, 18 to 21, we feel very comfortable and confident.
Thank you, Ms. Loya. About your question on the tire and automotive, I think Arno has given you a fair idea about the tires, but wanted to re-emphasize that when we say automotive, we wanted to share with you one of that piece, tires, today. But otherwise, automotive as a segment in IVL includes tires as a main revenue stream, but it has very strong other revenue streams which are supporting the automotive business, is the airbag yarns, where we are very significantly present worldwide, having a second position, 25% share in the world. And then besides this tire and airbag yarns, we have presence in the automotive interiors. We are the largest in Europe in the headliner space, car headliners, interiors, seat and panel business, and then trunk liners and acoustic fibers for insulation and for the engine compartment. So altogether, this whole automotive business is a very attractive piece. As Ms. Loya said, we do have very decent returns in that, and this business will grow over 1 billion in a very short time because we are attaching a lot of importance to it.
Okay.
Just to add that tire cord capacity is getting expanded in China. So that's what you saw, that it's already under construction.
So, any more questions? As you can see, different people can answer questions about different subjects. So, please feel free to talk on.
By the way, I became a grandfather a week ago.
Yay.
And I'm waiting for Mr. Gill to send me free Pampers. Or diapers.
Okay. Are there any other questions? Please feel free. Okay. I can't see anybody raise their hand.
Yes, here.
Yes? Okay, go ahead. Oh, Napat, is it? Good.
Hi, Kunalok. Yeah. First of all, I'd like to congratulate you for being a grandfather.
Thank you.
Going back to the slide of the slide 14 and 15, that you show us about the industry spread and also IVL spread. I have a question about the 2019. because both of the graphs shows a declining trend in terms of spread in 2019. And I look at the shaded color on the graph. It looks like the PTA, the West PTA, and also the West PET that is pulling down the spread. So my question is, what is the reason behind this? Is it because of the additional capacity or some other reasons? And because I also remember when we acquired the Portugal PTA, 700K tons, and because we expect the PTA Europe because of the tight supply, and we expect the PTA Europe spread to go up. So I looking at this graph and the information that I received, it doesn't go together. So I like to know the reason behind this.
Yeah, I think that's a very good question, and also signifies that I'm not a good CEO. I cannot push my businesses to show better margins than historical margins. So the way we do our number crunching is that we've used second half numbers as a basis for forecasting. And on this particular slide, you don't the graph going up and down is based on IVL's weighted production. It's not only the industry, but it's our product mix. And you said it very correctly that Portugal in 2019, 700,000 tons, will be actually the least accretive. It will be accretive because we pay a low value for that business, but it will be the least margin business. So that will drag down the weighted average margin for IVL. If you take out Portugal from 2019, then you will still see a growth of average margin. But 700,000 tons of PTA in Portugal, our European PTA margins enjoy profit because they are co-located to PET. We don't have much freights. Rotterdam is co-located to PET. Spain is co-located to PET. Portugal is a standalone part. So where Portugal will enjoy is the synergies with the rest of IVL, our procurement synergies, and we need to serve our standalone PET plants, whether they are in Turkey or Lithuania, with PTA. So Portugal will have to suffer high cost to serve our other PET plants. So to that extent, it may look as if the margins are coming down in 19, but actually they are not coming down in 19 for the rest of the businesses. Rest of the businesses, the margins are actually steady. Let me give it to you another way, the information. Mr. Agarwal ended his section by saying he's very excited about Q1 results. So his excitement about Q1 results is because they are better than projections. So because the projections are based on H2 numbers. And H2 did not have the best margins. No, that is quantity. H2 had less quantity because of shutdowns, but even the margins were not fully captured because we had contracts from the past. So new contracts in the West, the full volumes coming through, the crackers starting up in Q2, the incremental projects including the fiber, performance fiber in China, and I think somewhere in the third quarter you start up Indonesia. Third quarter they start up the commodity fiber in Indonesia. In China, our PET plant in China has now become one single line of 1,000 tons per day of SSP. Within IVL Group, that becomes our largest single line. So this was a debottleneck. So this was not a new facility put in. So you can imagine when you debottleneck a project, it costs like 50% of a new project. So we'll have better capacity at lower cost. So all of that is built into 18 and 19. Do not take the 19 drop as a drop in spreads. It is just the impact of our product mix.
It's basically weighted average. So as the Europe PTA margin quantity is going up, right? So when you calculate the weighted, it drops. But 234 is the weightage of each capacity. So where the capacity increase is happening. So conversion cost also drops. So it doesn't mean EBITDA per ton is dropping, you know. So this is a blended weighted average spread. But then the conversion cost is also lower because you are producing a product like PTA where the spread is lower, but conversion cost is also lower. So it's all weightage impact.
And is it because of the logistic issue at the Portugal that make the least margin? Can I say this?
Yeah, Portugal will make the least ex-works margin because it has no co-sited consumer. But it's very strategic for Indorama for our supply reliability. So in EMEA, we are now fully captive or not after Portugal?
No, we will have much more.
So we still have to buy or sell?
Sell.
So we have to sell 200,000 tons of PTA in Europe. We have total capacity in Europe of 1.7 million tons. 1.5 million is for captive consumption, including Turkey, and 200,000 is for domestic merchant sales. Sorry, this is very granular, but Vikas can work through all those numbers with you.
It's all weightage, nothing else.
My last question on the committed capex by 2019, 1.8 billion US committed. So if I look at because your cracker is about to be completed, and now you have only Portugal PTA pending for completion, acquisition. What else is in this committed capex?
So I think the breakup is given by Vikas maybe in the MD&A or here. 1.8 billion includes 750 million, which is carry forward capex from 2017. Correct? Roughly? 760 something. So $1 billion is to be incurred on the cracker, on fiber, consolidation of India PET. I think those will be the major capexes.
Okay. One more at the back. Oh, Pope, go ahead. That's you.
Yeah, we can hear.
I'll repeat the question. So since IVL is one of the potential bidders for Corpus Christi project in the U.S., what does management think is your best estimate of the startup timeline for this project?
So I don't think IVL is interested to buy Corpus Christi entirely. So one should not assume that. At least I'm not assuming that. The startup, we believe that the PET would start up maybe a year after the restructuring is over. So assuming restructuring gets over by middle of this year, then maybe by middle of next year, the PET section can start up in phases. It's two lines. So in phases, it will start up by middle of next year. And the PTA probably a year after that. So we are talking about PTA in let's say second half of 2019, and no, 2020, and PET starting up somewhere in the middle of 2019. This is my personal guess, but I think it's still a challenging project because we don't know really how much it is completed and how much more it will cost to complete that project.
If I can ask a follow-up question on that. So would it be in the best interest of IVL to postpone the startup timeline for this project, given expected tightness in the PTA in North America?
No, we would like this project to come about as soon as possible because we would think that the market needs that project and the customers require that product, both PET and PTA. Because without that project, for instance, PTA would run at about 95-96% utilization, which is very high, doesn't leave any room for error. So it is important that both PET and PTA starts up as soon as possible. And we would be supporting that.
Thank you.
Okay, so still have a minute or two. If there are no questions, we will bring it to a close. And there doesn't seem to be any hands up. So if it's okay with you, could I just bring the meeting to a close for today? And thank you all for coming. And thank you for the very interesting questions. Have a good day.
Thank you.